But as soon as you have to hire a team of 2 or 3 people, or 2 or 3 missing, skills in your arsenal of how to do it as well, then you have a problem.
You can struggle on your own, or you can go and find help and kind of maybe fail faster so that you can get to your next bigger idea and then try again.
So what is the alternative? Well, a good alternative is, why don't you get a venture partner like Specno on board, and they can build that first version of it for you by having a team that's well-oiled and can jump on this quickly. Sure, there's a premium to this, right? And a lot of them have these models that in time they're going to roll out into long-term plays, like the Delta's doing with building out a venture studio and getting some LPs behind it to invest in some of the long-term plays, right?
Welcome everyone to How Would You Build It? This is episode 10, Rainier. Welcome.
Wow.
It's been 10 episodes, yeah.
Well done.
Yeah, well done to us.
Well done for the person who's been listening every week.
Yeah. Well, the thing is, like I was saying to you earlier, there's a storyline that we have, and there's a thread that kind of leads through all our conversations. And I think if people latch on, there's a lot of learnings, because we're bringing all these different ideas together. Like, I just think about the concepts and some of the when we spoke about AI ideas, I mean, there's some fascinating things. And we've actually, I mean, if you're paying attention, you'll actually see how some of these startups are actually taking like traction. There's people doing things that we're saying.
And that's what it's all about, right? It's about sparking ideas. No matter if you're a founder or you work in corporate, or if you're interested in tech and you like the idea of building things, or you are in the periphery of things getting built, I think that's what we're talking about, right? So how do we get these things? How do we help people, encourage people, inspire people to build better things?
Well, the thing is, we talk like, okay, yes, I don't want to kind of beat the constant drum of AI, but in our conversations, we keep talking about how fast things are moving. And crypto was the same thing. When that was the kind of technology, it doesn't mean that crypto's dead. It doesn't mean that AI is, kind of just going to fizzle out. These things are constantly moving, and it's very difficult to stay abreast with what's happening and to make sure that you are not missing the boat, because it's very easy to do that in this space. I mean, you could be a corporate today that is kind of owning an industry, but we've seen, I mean, okay, maybe the most cliche example, but Blockbuster and Netflix. I mean, how easily you could be a leader, but by not actually watching the trends of how things are moving, you fall off very quickly.
Exactly.
Yeah. So in today's episode, we're going to be talking about, if you were a founder and you wanted to build, there's 3 main strategies that we've kind of highlighted, which is 1, building it on your own, kind of going solo or with your co-founders. The other one is meeting up or joining up with a venture firm, a venture studio. There's quite a few of those that have popped up over the years. And then the other one is actually joining an accelerator program and getting funding, building into these VCs. So, yeah. I mean, Rainier, if people don't know, you've got a very rich history of helping and consulting with founders for the last, I don't know how many years. You've got, close relationships with the likes of OfferZen. So you've really been, on the ground and seeing how some of these startups have started from zero and have, some have obviously failed, some are still growing and all of that. So what's your general feel on this approach to when you have to think about how you're going to do your startup?
Yeah, I think South Africa doesn't have a very strong entrepreneurial culture, or at least it leans towards a lot of different people taking this serious as a career path. Well, compared to the US at least, and I think it has a lot to do with our education system and just our history as a country as well. Like, I mean, anybody that's watched any kind of American TV for some time would have seen the example of either the lemonade stand or the Boy Scout or Girl Scout cookies. They have to go out and they have to be entrepreneurial, right? So it's really the DNA of America to encourage people to start a business, to hustle, to make some money on the side. And that's not something that's that prominent in South Africa. So a lot of times people, even people that want to build businesses start out maybe in their 20s, and that's something I did, and go, let's build a business. And then in my case, to a large degree, I did so out of ignorance, not understanding what it would actually take. And then once you make that commitment to say, I'm going to make this thing work, and then you do what you need to do to learn how to make it work. But to a large extent, it's there's a lot to be learned from a culture and thinking about these different things perspective, which makes it a bit challenging for people to just jump in and start something in South Africa. On top of that, we've got really strong corporates in South Africa. Like if you think about it, like our banks are really strong and they do well. And, you know, our retailers, we've got some retailers that have been going for years that are really strong. You know, they employ lots of people, right?
Yeah.
And a lot of talented people get out of university and having to, you know, live on noodles for a few years. They see one of these big corporates offering them a nice salary, and they see some student debt on the side, and they go, "Cool, maybe you know this is the way to go."
Yeah.
And then they get tied up in corporate, which is not the end of the world. It's a great place to learn, and I want to encourage more people in corporate that are, you know, spend a few years there and have a good idea of how to do something better, which they've seen over the years, to jump out and actually start a startup. So
yeah,
a lot of context of South Africa, you know, our backgrounds and the kind of opportunities that are available. Also, you know, GDP has been flatlining for a few years, which just, you know, it's not the kind of environment that you see a lot of new businesses take off and become big quickly. So, you know, it's not been a great environment, unfortunately. But that being said, there are 3 different ways, which you're going to chat about today, of how to do that. And there are people definitely doing this successfully. And there are definitely different ways of doing it.
Yeah, no, agreed. I think you're so right about looking at it from a South African perspective. It is risky, and you know, if it goes wrong, it's very difficult to get momentum back in your career. And I think that is what people kind of shies them away from it. But it shouldn't. You know, there's so much opportunity out there. South Africa used to be the land of opportunity. You know, there were so many things that you could tap into because they were just so untouched in our country. And I still think it's the case. You just got to figure out the market. With that being said, kind of one of the things I started researching on the subject is to kind of, as a founder or as a founding team, is to understand your strengths, weaknesses when deciding, right? Because each one of these things, so if we talk about a venture studio versus the accelerator versus doing it alone, it's what is the other parties bringing to the table, right?
Yeah, so I think, well, firstly, there's a lot of confusion around these names, around like accelerators, incubators, and what they do, right?
Yeah.
But it actually, if you unpack the words, they're quite simple. An incubator actually takes something that doesn't exist and gets it to a place where it kind of lives on its own, right? So if you were to incubate a small little chicken, you know, they'll get out a healthy chicken on the other side, almost ready for KFC. But you know, an accelerator actually takes someone and just takes them on a path to get faster where they intend to go anyway, right? So there's a lot of business incubators around in South Africa, and I think there's when it comes to university, there's a big space for that, like the university environment. So we have these research concepts and we have these ideas and stuff that is now developed into IP. How do we incubate this and see if we can make a business out of that, right? On the other side, you get accelerators, and this really was pioneered by Y Combinator, and we mentioned Y Combinator quite a lot on this podcast. And what I find fascinating about YC isn't necessarily the program and all the successful startups that have come through it, but it's really a well-designed structure that was perfect for its time, right? And they designed it in a way that's really just helped them get a flywheel effect. So, you know, they're now Ivy League accelerators. So they attract the best talent. And now it's almost a self-fulfilling prophecy, right? You expect great stuff to come out of YCY because the best people go to YC. Okay?
Yeah.
And I'm generalizing, but you know, it's kind of the idea of great universities as well. Like the top talent want to go there, so they end up you know, producing the best results. But now you can argue, is it really the best program, or is it just the fact that they attract the best talent? So Accelerator, and I love the YC model. So what did YC, why do I like it? So they identified that there was a massive gap in the market where there's a lot of people that want to invest in later stage startups, but they don't want to take on the risk of the early stage, right? And if you unpack the risk in early stage, like there's a few things that plays a role in that. And one of the biggest things is actually the time to figure out whether or not this is going to work is sometimes too long. Right. The second thing is, if the time is too long, someone else can jump you and capture that opportunity before you. Right. So YC said, look, we know a lot of people that want to invest, but they don't want to go in early. So can we take this process that would typically take 12 to 18 months and do it in 4? Right. And that was really the idea. Right. Now, YC, they get you there, you stay with the people for 4 months. They basically, the funding they give you is basically just to stay alive there, which is also quite interesting from a South African seeing that the first time. You get like 1.5 million rand, and that's just to keep you alive for 4 months in San Francisco.
But you have
I
one
think
objective, right?
yeah, and just so you can focus for 4 months on building, right?
Yeah.
And it's funny because most startups in South Africa with 1.5 million, they can probably run for 18 to 24 months. So anyhow, but the idea is then after 4 months, they get you funding, and then you're on your way. You've been accelerated, right? So they really compress this time it takes, and then they get the upside benefit of having equity in these startups, which, by the way, another part of the design, which is beautiful. They hand it off to a Sequoia Capital or to a 16Z or some big VC firm that really understands that scale game, and they don't really have to be involved anymore. So a lot of the times, if you invest, well, not a lot of the times, the model is if you invest in a startup, you're going to portfolio manage that startup. You're going to have to help them succeed, right? So if you take early equity in a startup, not only do you give away a lot of money for the amount of risk that you take on a lot of risk. So that factor isn't quite in balance, but you also have to spend a lot of time making them successful. So now you're taking out 18 months of your time to get them to a phase where they can raise the next round of funding. And that's where the YC model makes a lot of sense. Let's do it in 4 months, put a lot of effort in, take a nice little bit of equity, pass them over the wall and see another VC make them massive, or even take them to an exit, and then it's obviously a great upside for them. So that model is really the model that really started the accelerator phase in the world. And a lot of people have tried similar things across the world with varying successes. I'm yet to see someone in South Africa pull it off in a similar kind of model. And the question remains of whether a model like that would actually work. The verdict's actually out if traditional VC works in South Africa. So we're not sure if VC works. It's hard to say whether a model that accelerates startups to be investable by VC could work. So yeah, I think Startup Bootcamp has had some success. They did something similar, but they also did, I think, 2 or 3 seasons, and then they changed the model. But I believe they made some good returns, specifically of Kuda Bank up in Africa. Was one of the startups that were part of their portfolio. So they did well. I think it just takes time, and a lot of people get impatient. So if it's going to take 5 years before you get any kind of meaningful return in a setup like this, then it's probably going to take a brave man to put a bet on something like this.
Yeah. So if VCs are struggling and these kind of setups, accelerators are struggling in South Africa or Africa, what would you contribute to its failure? Why is it struggling? Because the model is, it works. A lot of what we do is we look overseas as Africans and South Africans, we look overseas to try and replicate and understand how they're doing it and doing it here. And the model is obviously copying and paste, but it's not working. Is it purely just like, for me, like liquidity? It's just, is there enough in the market for what we're trying to build here? Is that the cause, or can you think of something else?
I think in any business, it's really important to align as far as possible all of the stakeholders involved, right? So I'm talking straight through employees to executive to shareholders to people giving money to the shareholders. And if you think about this model of VC, you've got LPs that give money to a VC.
Just explain an LP for those that don't understand. What's an LP?
Yeah, so it's a limited partner. And they sorry, not a limited partner, they're a liquidity provider. And a liquidity provider just gives money. So you have these massive funds that, sometimes they're government funds, sometimes they're pension funds. And recently Eskom said their pension fund is going to dabble in VC, but only in developed countries, not in South Africa, because everyone knows you can't build a startup when the power keeps going off. Anyhow, so Eskom's pension fund is going to become a liquidity provider for VC funds in America and developed economies. And then they find specific funds that say, we've got a mandate. We are going to invest in green energy, these kind of criteria, this stage of the business. This is what we're looking at. And they then the fund is then only allowed to spend the money on, those certain things based on what these people ask them to do. And then there's also a target rate of return and those kind of things that these funds need to work towards, which then poses limitations and constraints on these funds, right? So these VCs go, cool, I can only invest in startups that are generating upward of $1 million a year in revenue, right? Because the risk in anything lower is too much for my LP. They don't want to take on that risk, right? So now they're saying, cool, we can only do that. So now they sit around and wait for deals, right? But on the other side, they might think, I'm seeing a lot of deals that actually doesn't fit the mandate, that would be good investments. Personally, I'd love to invest. Now I can't do that, right? And then, on the other side, founders, there might be a mandate that says, that they need to work towards an exit within a 5-year horizon, right? But now, there's a founder that says, cool, I don't want to work towards a 5-year horizon. This is a longer term play, maybe want to list between 5 and 10 years from now. Okay. So now all of a sudden it's really hard to align all of these people. And in the US, you just have so much more scale that finding matches between these different mandates and different alignments is just so much easier, right? So I think that's the first thing. The second thing is just liquidity in the market, right? There's people buying all kinds of stock in America. Like there's a lot of money floating around.
Yeah.
So the opportunity for exits, one of the major plays in America is building a startup to a listing. Right. In the newsletter last week, we covered and we spoke about it on the podcast as well about the unicorns, right? ByteDance's valuation at $225 billion based on their last raise, but they did $80 billion in revenue last year. Compared that to Tencent, is a listed company, and their market cap is $450 billion, I think, but they're also doing 80 billion a year. So these guys are building towards a listing, which is probably going to be 5x bigger than what they raised at, probably above $1 trillion. And then the last investors would make a 5x. So now, once again, mandate, we don't know. On the inside would be very interesting to know, like, what kind of objectives do these investors have? Because maybe it's most likely it was discussed that they'll invest at that valuation, but they'd like to see a exit at least a certain multiple of that within a certain time. Yeah. And one of the reasons I'm thinking about that is the fact that they are actually buying back shares from the shareholders at the moment. There was an article about it. And it's probably because some shareholders are thinking, you know what, we want to exit now, whilst other shareholders are thinking we'd love to build towards a bigger exit at a later stage, or a bigger liquidity event. So a lot of these mandates just make it so hard for an African VC to make it work. Specifically, two parts: one, the amount, the size of the market, and secondly, the exit opportunities.
Yeah, it's very interesting because I'm just thinking, like, as you're talking, so I've spent many years working in the space of a venture studio, or even call it a dev house, where people come in, they've got their, and the big word here is budget, right? So you, as a founder, if you're not getting funding, or if you do have funding, you still have to make the most of your budget. Runways, like when you're working in an agency, you can't not talk about the word runway. It's like, you have this amount of money, what's the best way to spend it? And I guess that's why we have these venture studios. It's why we have these venture builders and all of that. It's to kind of help you make the most of what you have. But it is really, really difficult for me. That's kind of always the person that they come to and say, okay, cool, can you build us this plan? Give us all the bells and whistles. And you've only got, let's say 1 million rand to do it, and you have to do it in 3 months. And then that your devs are going to cost like 70% or 60% of that budget. You have to make sure what you're building is spot on, and that you have sort of a distribution and growth strategy. You go down on this all the time. You constantly, which I really appreciate, is you always talk about, revenue first. Get yourself to revenue so you can just prove that this works, and that you can kind of potentially go get more funding or whatever it is. But anyways, when you're on the ground, you got your designers, you got your product managers, you got your, the devs, everything is expensive. It's really, really hard to do. And I guess going to one of these kind of partners, they kind of help you, they should help you fast track it. The problem is that what I've experienced in South Africa is that we don't get to a revenue stage fast enough. So we build really, really amazing things, but some of them don't even see the light of day, or they just don't get enough traction for it to actually go to that next stage where we can start even talking about an exit or another funding round or whatever it is. I always joke about where is the graveyard for digital startups in South Africa or Africa, because I think there's been so many amazing ideas I've come across. That's what I love about having worked in these environments, is that you get exposed to all these amazing ideas and things people that are wanting to build, but they just either it's the wrong team, or it's not enough budget, it's not enough traction, and it just kind of doesn't go anywhere. And it's just so sad. It's like, where do we go find these old products that we could potentially revive when a market is in a place that can help it go? But yeah, what's your view and your experience on having to manage budget when you in these three different kind of strategies, with being the accelerator, incubator, or doing it yourself?
I think something that I find fascinating is, there's a group of people, not a group of people, like sometimes you see people building amazing businesses and they don't follow the track of pitching at an event or going through Accelerator, or they just build these businesses, right? And Rain is an example of that. We mentioned Rain last time. I just saw from the investor conference they committed to invest another 4 billion in infrastructure.
Wow.
The Cyril's investment conference. So and they're really putting up 5G infrastructure everywhere, but they're building the business. How can I explain it? My perception from what they're doing is that they're not building a startup. They're building a healthy business, right? So they look at the fundamentals of the business and how that's gonna make sure the business is successful in the long run, and then building it from that space. So they're less focused on, what is the startup way to build this, and more the, how do we build a solid balance sheet? How do we ensure there's enough cash flow? How do we make sure we grow revenue over time? How do we reduce risk? How do we set up partnership that can help us, unlock strategic value? These guys were talking about buying Telkom. I mean, that's insane. They're doing business. They're not building startups. They're doing business.
Yeah, and that's Patrice Motsepe here. He's got quite a nice portfolio of these.
Listen, there's some smart guys in there. Michael Jordan is also in there. Ethos AI Fund. Not that well known, but they behind Rain, and not well known in the startup circles. People in finance and private equity space definitely know them. But they've invested in Rain. They've invested in Time Bank. They invested in CrossFin. So quite a few big plays. So and some of those guys involved in there also recently announced with Michael Jordan a new, I think it's $1 billion AI fund. But it's not. They don't put it out as VC. They're just building businesses, right? So I think that Time Bank's the same thing. These guys are just iterating away, and they obviously, as with anything in building these businesses, really complex, facing a lot of challenges, figuring out how to do growth, figuring out how to get that strategic advantage. But they go about doing these things, building these businesses, right? And it's not a startup. It's yes, it is a startup by the pure definition of the sense, but they don't follow that track. They just build a business. Yeah, I think that's quite a standout thing. Like, a lot of times we disregard the business side of things because we think about startup philosophy and startup methodology. So we go, okay, cool. You need to validate the product. You need to do interviews, and you need to, you need to do all those things. And yes, you absolutely need to do those things, but you're also building a business. I think it's quite important to distinguish between the two. Now, the other thing that we're talking about today is venture studios, and that's quite interesting, because if you have a venture studio or a venture partner that focuses on those things, perhaps the job of the founder could be, let's build a business. Let's make sure we cover all these other bases. Yeah, and I think that's also a very viable model for South Africa.
I think a term that's coming into my head a lot of the time as we're talking here is equity, and I think there's a conversation there all on its own, right? So now, going with those three different kind of strategies again, equity, right? You do it yourself, you get to keep all your equity. Going to a venture studio, you might have to give up some of that, or going into an incubator, like you said, YC do it. They take some equity for those exit rounds that come later. What have you seen in the market when it comes to giving up equity? How do founders kind of, negotiate that difficult conversation?
So I think it's important to understand that whether you take a venture partner on board or go into Accelerator or give away funding in a fundraise, you're technically taking on a co-founder, right?
Exactly.
And how one should think about it is like, time is money, and there's some value to network and specific skills as well. So each of these would bring forth a combination of a faster time to market or faster time to exit, some component of finance, like either a reduced salary or a give you actual money or save you cost down the line, and then expertise and network. They would have all have done something along the line, have learned certain lessons, and can bring that knowledge on board. And it's really a case of trying to figure out, what is this going to do for the business going forward? So as a founder, you want to find those kind of deals where you can see that which they're going to bring is going to be worth more for you than what you are giving away, technically, right? So how does that look? Well, it's really understanding what they're going to bring to the table and where your shortcomings are. Right, because if your shortcomings and their strengths match exactly, then you're getting way more. Then the benefit for you is substantially more than simply just a financial transaction, that brings about money or time saving or something in exchange for equity. Because as a matter of fact, if you don't cover some of those bases, the business might not succeed at all. So it's really about finding those matches. And once again, in South Africa, it's hard because you have a few hands full of VCs that have specific sets and experiences, and a lot of them somehow tend to be past lawyers or finance people. So if you are strong in legal or finance, or if that's not something that's big in terms of what you're looking for in your startup, or a lot of value it can add, then beyond the capital and a bit of network, it's quite limited in terms of what you can get from that. So whereas YC was started by a bunch of ex-founders, people that have had exits in other places and came back and said, cool, let's put this thing together and help some founders. So I think that's a core difference. So we'd love to see some African founders exit unicorns and come back and build accelerators, because I think they'll be better at it than most people.
Yeah, so, that's an interesting topic you just brought up. But yeah, I just remember going to a talk, I don't know now, a year or so ago, probably longer. But the lady at Knife Capital, I can't think of her name right now, but she made a very interesting point in saying that because like you just said, there's such a small market of VCs out there that they all know each other. And they've probably seen the same pitch decks, that because there's a lot of people that are putting these pitch decks together and then sending it and seeing who would catch them. And she was making a point of how they all talk to each other.
So they all have the same limited partners as well, LPs. I said liquidity provider earlier, it's limited partner, but limited partners are liquidity providers. So that's where the confusion sits. The SME fund is behind a lot of the VC funds. They give them money based on certain mandates, and I can tell you with certainty that they're all in the same WhatsApp group.
Yeah, literally.
Literally in the same WhatsApp group. So yeah, the market is quite small. So but it is, there are differences, and there's some really unique, amazing VCs. Big shout out to Nick and the team at Savant. I think they're incredible. They've got a hardware-based startup. And they also have a hardware-based accelerator with a fund behind it. They've been doing amazing work, and Nick's been doing it for almost 20 years. Like most people don't know this. I think they've been doing it for 18 years. So he's seen a few things. They built a few stuff. And they're typically engineers with MBAs, which I think is pretty cool. And go into building businesses using,
well, exactly.
So I think that's a great one to check out, and some other ones as well doing amazing work. So I think it's about finding the right partner.
Yeah, I think the biggest thing that I'm kind of taking out of today's conversation is it's actually, we know that it's very difficult to start a startup. So there's like bad stats around being an entrepreneur and starting a business, whether you're in Africa or in America, where they've got this ecosystem that we're talking about, it's difficult nonetheless. But the main thing is you can struggle on your own, or you can go and find help and kind of maybe fail faster so that you can get to your next bigger idea and then try again. That's the kind of the theme that's sticking in my head now. It's like you can go alone, bootstrap it, and struggle along the way, or go join a venture studio that kind of know how to get to the point of figuring out if you should be pursuing this or not, or helping you get to that revenue point. And I think that's a big theme that I'm thinking of.
Yeah, there's another thing that venture studios really help with. They've got well-oiled teams that have skills across multiple disciplines that's required to make a startup work, right?
Mm-hmm.
So if you're a founder and you go, cool, I can maybe do the business side and the networking and sales side, but I can't do graphic design. I don't know product. I don't have software developers. And you go, cool, let's set out and hire a team. Okay. For you to find great talent, convince them to join your startup, and actually have them all start at the same time so you can build this thing is incredibly difficult. In fact, I would say it's close to impossible, right? And I've not heard of someone that have pulled that off successfully. So typically people that do that are already a developer themselves and they just go hire a designer. Like that's something you could do. But as soon as you have to hire a team of 2 or 3 people, or 2 or 3 missing, skills in your arsenal of how to do it as well, then you have a problem, right? So what is the alternative? Well, a good alternative is, why don't you get a venture partner like Specno on board, and they can build that first version of it for you by having a team that's well-oiled and can jump on this quickly. Sure, there's a premium to this, right? You're going to pay a bit more. There's some margin into that. But the reality is the cost of not being able to start immediately or not being able to start at all because you can't assemble a team is sometimes higher than the premium you'll pay to get a team to get going. So that's definitely an option. And, these venture partners, a lot of them have these models that in time they're going to roll out into long-term plays, like the Delta is doing with building out a venture studio and getting some LPs behind it to invest in some of the long-term plays. That's definitely a model that's also potentially very lucrative in South Africa, and definitely at this stage very underexplored. Overseas, we've seen some major successes with venture studios. They're way more successful than accelerators or just early stage funds. So yeah, massive opportunity to explore there, I believe.
Yeah, I agree with that. I think we're going to have to call it for today, but I think there's a lot of conversations that we could kind of build on this. Like, this isn't the end, right? I think, we could sit and just have a conversation around building out a budget and understanding what you can kind of evaluate your potential idea, how much it will cost you to get there, and then kind of break it down and understand what money you need to go chase if you want to go to a venture studio or an LP or whatever it is. So let's save that in the arsenal for another episode. But Renee, it's always good to chat to you on how would you build it, and look forward to our next conversation.
Okay. Cheers, Bobby.
Cheers.